The Infinite Banking Concept Cost Recovery Strategy, Part 2. This is Victor Cuevas with Victor for Advice. In the first video, we left off with this slide. And we were talking about the way we normally conduct business, and that when we have cash flow come in, that cash flow goes out to pay our expenses. So if we have $50,000 in expenses, we need to have $50,000 deposited into an account to pay for that expense. We talked about if you do that every year for 20 years, you would have deposited $1 million to pay those $1 million of expenses, and you have nothing to show for it. Now, when you apply a banking model to your business, what you do is, using money that you have in excess cash flow in other accounts, brokerage accounts, bank accounts, you decide to be the bank and you deposit $50,000 into the account, and then you lend that money to your business. Your business uses that money to pay the targeted expenses, and then in turn, through cash flow, your business pays you back the $50,000 with 10% interest for a total of $55,000. So you've made a deposit into that account the first year. You loan it, it comes back to you at $55,000. You earn interest 1%. You pay taxes on the interest. You have an account balance at the end of the year of $55,350. The following year, you make another $50,000 deposit. You loan it out to your business. Your business pays you back the $55,000. You earn 1%. You have some taxes that you need to pay, but at the end of the year, you end up with $111,000. You continue to do that every year for 20 years. You've made $1 million in deposits. You've paid those $1 million in expenses, but instead of having zero show for it, you have almost $1.2 million in your account. So we agreed that was a much better way of conducting business, because you've basically become your own bank. You've taken idle money, you've put it to work, and now you have something to show for all those expenses that you paid out for 20 years. And this money is available then for you to do anything you want to. It's created extra wealth in your life. But with the infinite banking concept, we have a better strategy to apply. Still a banking function, but it works better. And that's what we're going to look at next. Infinite banking concept, cost recovery. The setup of the business and the business owner is going to remain as it was from the previous scenario. You still have those deposits of $50,000 to be made, but only for the first 5 years. Remember earlier when we agreed that you must make at least a $50,000 deposit to pay for a $50,000 expense. In the cost recovery method, in the 6th year, the deposit is reduced to $18,000, and then in the 16th year, it's reduced again to $17,890. So you still have this targeted expense of $50,000 that you will need to pay for the next 20 years, but you will only deposit $520,523 during that 20 years instead of $1 million. That will save you $479,747, almost $480,000. That's savings in cash flow that just goes into your pocket. No taxes are due on the growth of the money in that account. You still will loan out the $1 million. You still will receive repayments of $1.1 million. At the end of 20 years, the account value will be $839,697. All this money tax-free. This, despite the fact that you contributed $480,000 less, you still have a very strong account value. It's all tax-free. So when you consider an ending account value of $839,000 and some change, and a savings in cash flow of almost $480,000 during that time, the total value to you as the business owner is $1,316,444. That's incredible. That's a huge difference from the previous illustration that you saw. Clearly, the infinite banking concept cost recovery strategy is superior than just using a regular bank account. Here's a flow chart that further illustrates this method. Again, the business owner, you are still depositing money into the account that's then offered to your business as a loan. Your business still is receiving revenue to pay expenses. You have $50,000 over here in other expenses. You loan your business of $50,000 to pay the targeted expenses you want to recover. Your business with cash flow repays you the $50,000 plus 10% interest or $5,000, a total of $55,000. The process is repeated year after year. The business is still deducting expenses and is also deducting interest paid on the expense. Here's the illustration for the infinite banking system. Now you'll see right off the bat that the first couple years you'll see some negatives going on. I'll explain that in a minute. You still have $50,000 going in, but again only for the first 5 years. You see that it drops down to $18,080 and then again in the 16th year to $17,890. Here's the interest earnings. You see that after the third year, in the third year going up every year. The longer you have this account, the more efficient it becomes. Here are all the earnings during that time. Total earnings. Here is $267,000 and some change. Much more than the $131,000 in earnings in the previous scenario. However, all zeros in this tax column. No taxes were paid on this. And here are the repayments, the loans and the repayments of $55,000. And here are the account balances increasing. You see here that at the end of 20 years you have this figure of over $839,000. Again, all tax-free money. So, again, you've saved over $480,000. You've only deposited $520,000 and some change, but you still have covered $1 million in expenses. Again, this is fantastic. And so you would ask, well, Victor, what are you using? What financial instrument are you using to make this happen? Well, we have found that the best financial instrument to use for infinite banking is a specifically designed whole life insurance policy with paid up additions rider taken out with a mutual life insurance company. A mutual life insurance company is owned by the policy owners, and therefore you receive the dividends instead of stockholders. Now, the first thing that comes to your mind is, well, I've heard all kinds of bad things about whole life insurance. There are many gurus out there that appear on TV, write books, and they will tell you flat out, run away from whole life. And I will tell you right now that anyone who says that whole life is a bad place to put your money hasn't a clue of what they're talking about. And I'm right up front with that. Now, why would you even consider a whole life policy as a bank for your business? Well, first of all, I want you to know that the largest purchaser of whole life anywhere are banks. Banks purchase more whole life than any other person or entity in existence. banks purchase tons of whole life insurance. So if whole life is such a bad place to harbor your money, why would banks buy so much of it? Billions of dollars worth of it. Well, cash value in whole life is as rock solid as it gets, folks. It looks good on their balance sheets, pays great income, it's a great performing asset. They can leverage it for loans, they use it for their key employees. I mean, there's a lot of reasons why banks use whole life and continue to buy it. Also, for decades, high-level financial advisors that work with wealthy clients use whole life to harbor their clients' safe money. They consider whole life an asset class and may put 5 or 10% or more of their clients' money in whole life insurance. Whole life was started in the U.S. in the mid-1700s by the Presbyterian ministers, and Ben Franklin himself started as a mutual life insurance company. And they've been going strong ever since. So today we use mutual life insurance companies. Now, because of fractional reserve banking, banks are very vulnerable and always have been. Now look at all the bank failures that occur every time we have an economic crisis in this country. You can just go back to 2008 and see the thousands and thousands of banks across the nation that failed, including Washington Mutual, the largest bank that failed. Why is that? Well, fractional reserve banking, I could go into a whole lecture just on that. But whole life insurance companies, mutual companies are much, much better placed than banks to keep your money in. Whole life insurance is very flexible. You have easy access to your money, no limit to how much you can contribute, tax-free passive income to supplement your retirement, creditor proof in most states, including Alabama and Georgia, where I conduct business, tax-deferred growth of your money, and the list goes on of why whole life is the perfect financial instrument for infinite banking. This entire illustration is based right down the line with IRS code. So it's all legal and it works great. Getting back to these numbers here, because we're using a specifically structured whole life policy, there are some costs in those first couple of years. We call it capitalizing your bank, just like you would do a brick and mortar type bank. Now, even with that, the first year you still have $31,000 available in your cash value for loaning, and of course that money is available to you. But for this illustration, we're starting the loan process in the second year, where during that time you will have the $50,000 available to borrow from. At the end of the second year, you have over $72,000 in cash, and then the positive interest starts accumulating, and it goes up from there, becoming more and more efficient as the years go by. Now I want you to consider this line here, which is all the cash values that accrue in this account. But when you buy a car, equipment, or other major purchases, do you pay cash or do you finance it? Now, using the same monies, you can self-finance those purchases. Using the same model as earlier, loan the company the money for the new capital purchases and charge an interest rate. Now this additional money is coming back to you for use again down the road. Now you're retaining your cash if you pay cash. And instead of sending your money away to finance companies, it's coming back to you. Folks, I want you to realize that the average family throughout their lifetime will pay 34% of everything they earn just on interest for loans that they take out. Mortgages, cars, furniture, college, you name it. 34%. That's hundreds and hundreds of thousands of dollars just on interest on loans gone from the family wealth. And all the interest that money could have earned. So if you can retain as an individual, as a family, and as a business, the vast majority of that interest and use it to create wealth, why wouldn't you do that? It just makes sense. I mean, you can earn 7 or 8 or 9% on investments over here, but you're turning around and giving away 34% of your wealth to interest. Doesn't make a whole lot of sense. So you definitely want to look at infinite banking and how it could create wealth. This concludes video 2. But folks, hold on for video number 3. I have saved the best for last, and you will not want to miss it.